Hey everyone, it's Mike McGrean. Happy New Year. Today I'm going to talk about the tax-free savings accounts known as the TFSAs. Sure, I'll provide the high-level view, but I'll also dig into some of the common misconceptions and questions we've had on these popular accounts over the years. I'll share some best practices and also cover off some of the crucial things that you need to be aware of. Okay, Canadian residents who are 18 years and older with a valid social insurance number may contribute to a TFSA, but there are strict annual and cumulative contribution amounts to be aware of. And if you were 18 in 2009 when TFSAs were first introduced, the general rule of thumb is that you may contribute a cumulative total of $95,000 to your TFSA. Each new calendar year brings a new annual contribution limit. And this year's 2024 TFSA contribution limit is $7,000, as you can see. But if you don't maximize your contributions in any given year, not to worry, that unused amount will carry forward indefinitely so that you can fully catch up in future years. So if you were 18 in 2009 and say never made a TFSA contribution, you could contribute $95,000 in one lump sum and be fully maximized with your allowable contributions. Now, once you've made your contributions and your funds are now inside your TFSA, you must make a decision on how to invest those dollars. The choices are broad, as you can see, and may include stocks, bonds, mutual funds, exchange-traded funds, and often many private alternative investments which perform outside public markets. And also you have the option to own high-interest savings accounts and GICs. With all of these options, the TFSA could more effectively be named the tax-free investment account because you really have a tremendous amount of flexibility and options with regards to your investment choices. Okay, the really neat thing about tax-free savings accounts is that once the dollars are inside the account, you can switch from investments, no problem. You can earn dividends, you can earn interest, say on your GICs. All of that income and activity is tax-free income. Okay, I just want to hop back to GICs here again for a point. We have the largest offering of GICs available for clients here at Canaccord. We get the wholesale rates from all of the banks, the credit unions, the trust companies. We literally have access to around 40 different GIC providers, and most often our wholesale rates are better than the published rates of these various institutions. It's been a big advantage actually for our clients over the last couple of years, specifically with rising interest rates. Now, what about beneficiaries? Being a registered account, you are able to name a beneficiary. I'll touch on the three broad categories here. The number one here is the spousal beneficiary, known as the successor holder. Upon the passing of the TFSA holder, the tax-free amount of the value of the TFSA will roll tax-free into that of the surviving spouse. The funds will simply roll from the deceased spouse's TFSA to the TFSA of the surviving spouse on a tax-free basis. But other named beneficiaries, such as kids, grandkids, or siblings, the proceeds may pass largely tax-free to the non-spouse named beneficiary. I say largely tax-free because the calculation in this instance is a little different for a non-spouse. The TFSA is valued as of the date of death, but any increase in the value of that TFSA from that date to the date when the funds are eventually paid out to the named beneficiary, that would be considered taxable income to the estate. So the vast majority would be paid tax-free, but as you can see, there's a potential that some small amount of tax might be owed in the event that that TFSA grows before it is dispersed. Contingent beneficiaries are also known as secondary beneficiaries. In the event that both the account holder and the primary beneficiary, such as the TFSA holder's spouse, say they were to pass away at the same time, the proceeds of the TFSA would flow to the named contingent beneficiary, depending on the circumstance, and again, largely tax-free. Naming a contingent beneficiary is now an option for TFSAs, and it's good practice and good proper estate planning. In all three cases, TFSA proceeds being paid to a TFSA beneficiary may be paid into the beneficiary's TFSA regardless of their contribution room. Also, TFSAs with a named beneficiary do not incur provincial probate tax, which is really an estate tax and varies by province. But for Ontario, it's roughly a tax of about 1.5% of the value of the account. Generally, assets with a named beneficiary do not incur probate, such as RSPs, RESPs, workplace pensions, TFSAs, life insurance. Assets that would incur probate, though, would be those assets without a named beneficiary, such as your home or other real estate, your bank accounts, or other non-registered investments. So coming back to TFSAs, if you name your estate as beneficiary, the account will pass through your estate, and therefore it will be subject to probate tax, and the remaining proceeds will be paid to your beneficiaries as per your will. So again, important to look at all of these details. Make sure you have your account set up properly. So is a TFSA right for you? And should you contribute to a TFSA or an RSP? Another decision, but again, that's in another video we did, and it pasted the link here for you below. It's really a personalized decision. I mean, both of those accounts are tax sheltered accounts, and they definitely have their place within an overall financial portfolio. A lot of the times it comes down to your personal circumstances, what your goals are, what your needs are, what your income tax level is, for instance. If we can be of any assistance whatsoever, of course, just reach out. That's what we're here to do. Thanks for being with me today. Until next time, we'll see you soon.